Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Lynn & Associates with your agriculture update for this Monday, and we are now on the 16th of October, 2017, about 2 p.m. Central Daylight Time. As you can see, a sea of red in the grains, the cotton, the sugar market, the cocoa, the coffee. Dollar up today, not dramatically, but up enough to cause pressure in a number of the other currencies. The metals are giving you a late day sell-off, with the gold actually now making new lows on the day and getting hit, as you can see, right in front of you fairly hard. The one thing I'm noticing is we're not getting a lot of volume in these markets, and that's the interesting part. The Russell 2000 went up for a new high on the move, has had an outside day down so far, and it's leading the parade in terms of it seems to be ahead of the market as to when it decides the uptrends happen, downtrends. I am not saying it's a downtrend. I am saying it's a correction, and it might be telling us that the other indices might be doing that shortly as well. When I go to a soybean chart, you've had this nice rally on the weekly chart from 917 up to last week's high. Now, if we look at that high, it was a high of 1003 and a quarter. The high on a closing basis was 1002, and you've backed off there about 12 cents from the highs overall. When we go to a daily area chart of closes, you can see that you had approximately a 47-cent rally, and now the market is backed off from there, again on a closing basis, about 9 1/4 cents. This is a big pole in the market. It could end up being a flag. We don't know. But this range is very important. That low is no longer as important to me as it once was. Remember, because it went up and you haven't taken that out in the past 2 days, and that was made up of an outside day up as well, it's just now a swing line low that you can see right here. So you've got higher lows, higher highs. You're in an uptrend until you take out in the chart pattern 959, and support's waiting for this market in the neighborhood of 970 to 962, the combination of the 100-day moving average and the 18. That doesn't mean the prices have to get there, but what did stop the rally is very clear. It was the upper Bollinger Band. And when you get to these Bollinger Bands, often, not the word always, but often, they act as a brake on the market, be it the market going up, you're pulling back, or falling down, you're going to find support against it. Now, in all fairness, you haven't hit the lower Bollinger Band since August. So the market has had an easier time pushing forward in pricing than it is down. Is this the time where the market might get some selling off of the harvest pressure that's coming on? It could, but that doesn't mean that the market is out of its uptrend. So far, it's not. What happened, I think, is the combination of getting overbought, any reading in the slow stochastic that is made up of two lines, the red and blue called a K and a D. I view that when those numbers, either one gets over 70, they are overbought. And you clearly have a 77 reading. If we go back to Friday, you were 78. So you were overbought there on Friday, and the correction phase is trying to push the market at this point. Doesn't mean it has to go down, but it does mean that being overbought often leads to either one of two things, a correction or consolidation. And often that takes place with that number either working itself down out of overbought or going much more forward and eventually embedding. Beans have been able to get overbought and not embedded. In other words, where both numbers that make up the slow stochastic get over 80 for the longest time, since basically early summer. So I find that interesting. You had at one time, this is where the bearishness was because you embedded there. You haven't been able to do it to the upside. In the meal market, it's a mirror of what's going on in soybeans. You've got the pattern of higher lows, higher highs. You had 2 days in a row over this black dashed line, the upper Bollinger Band. Remember a Bollinger Band. The theory is you'll trade within them 95% of the time. My homegrown analysis is that each part of that 5%, you can give each day that settles out of it is one of those percentage points if they're consecutive. And that's what's going on right there. So you had a 3% chance today of staying over the upper Bollinger Band. You pulled back. That's all that it means. It also means buying the spike rallies over Bollinger Bands. You got to ask yourself if that makes sense. I'm not saying you can't do that and the market doesn't fall. You got to play what the percentages of the plays are. When we go to soybean oil, it's getting stymied by the 100-day average of closes in the green, and then the 18-day should act as something of support. The market doesn't have a pattern that you can call a trend. It's got a lower low and a higher high. Support starts at the 100-day average. Actually, it was resistance on the way up, so it's a bit of support on the way down. But the bigger support's 33.30, and you're not overbought here. When we come to the corn market, it's all about the 18-day average of closes. Since September, this is what has been the market has stopped at each time that it's rallied. You can see that. In the wheat, the whole objective when you lost the embedded reading on Friday, and this is how the market looked, was to get to the 18-day average. Whether you would change the trend and get over this 445 3/4, I didn't know. But when you lose the momentum, unless you gain it back immediately, which would have been Sunday night, the odds were favoring you're going to go for that 18-day average, and you don't know how far you'll go. Well, the market didn't quite get there yet, and it still lost the embedded reading. So as far as I'm concerned, you're still in that ballpark. What did you miss it by? 2 cents. You hit it in the KC wheat, by the way. In the sugar market, momentum was coming up, and you've sort of flattened out right here. You closed under the 18-day average of closes with the swing line in an uptrend. You're pretty neutral right there. Momentum, the question is, can it pick the market up? I don't know. The resistance is fairly clear between 1460, the 100-day average in green, and the upper Bollinger Band. Support starts right here. If you take out 1396, you break the swing line, the trend up, but your objective's only 1374, the lower Bollinger Band. It's sort of a market that's consolidating. Coffee. Coffee is in a downtrend, oversold. Maybe it reaches for the lower Bollinger Band. But how do you get short down here in an oversold condition becomes the big problem. In the cocoa market, how many times have I pointed this chart out to you? I want you to keep an eye on this. The market keeps finding support at the 18-day average of closes in red, but when it does it, inevitably you're in overbought condition. You're getting up to those upper Bollinger Bands, you fall back down, you're finding support at that number, and you did it again right here. It's a hard market to trade. Why? It's not that we haven't realized the trend is up. It's not that we haven't realized that the bias is up. It's where it's letting you in that becomes the hard part. In the cotton, you're in a downtrend again. You've got lower highs, lower lows, you're oversold. So all I'd say is, that lower Bollinger Band in that 67.53 area, I'd be a bit cautious of right here because you're knocking on the door of support. In the cattle market, if the cattle takes out the lows of 116.50, you will end up with lower highs, lower lows over the 18-day average, which makes it difficult because the bias is up, but the trend would turn down, and momentum is pointing down. Son of a gun market. In the feeder cattle, if the market takes out today's low, you end up with what? Well, you end up with lower highs, but you still have the higher lows. So until you take out the 151 level, it's a difficult one. The market's got downside momentum. It's at this point got higher lows and higher highs because we don't know if the market is just going to be able to hold today's low and move higher, or if it takes it out, then it's got that pattern of dropping lows with higher bottoms. In the hog market, you're in an uptrend, and it is overbought, but trying to convert itself from being overbought to embedding. Now, to embed, you have to have both numbers over 80 for several days in a row. You didn't have it on Friday, so you don't qualify for that. You're just plain overbought. I put that all together. try to come up with a game plan. And sometimes the best game plans are in looking at a popular trading tool called a pivot point. Now, let me explain what a pivot point is. You take the previous day's range, and in that range, what you're trying to find are resistance levels from it. It's a mathematical formula, and support levels. There's two resistance levels or sell points above would you come up as your median line. And we give you the formulas. We show you how they're all done, in fact, so that you're able to work with them. And then what I did is I created both a video to teach you how to work, in other words, with the formula, and then another video how to plot it on a chart. Today, I am going to record a third video. I'm going to do that late this afternoon, and I'm going to show you how to use, if you will, momentum indicators with pivot points. Now, none of you have seen this, and I'm not going to make it available to you if you don't get the first two videos. They're free. And it teaches you how to work with all this, and then you'll understand it. Example, these are sell point 1, sell point 2, buy 1, buy 2. When a market gets up to the sell point, you're looking for it to come back to this median point. Some people will even sell number 2 looking to get back to sell number 1. But there's many ways that you work with it. We do our best to help you understand all these different ways. They're not that hard to go with. And yes, you're going to be able to put them on your own charts. They are meant for more in and out trading. Oftentimes we get people to say, Ira, how do I find a point to enter or exit a market? Well, you do it with one of the tools, which is this. You can get it free, and there's 2 videos that we'll send out to you by calling us on this number. You can go to our website. You can click up here. If you'd like, you'll see an icon on YouTube or underneath us in many websites. It says, click here for Ira's free offers. Do so, and away you go. I'm Ira Epstein. You have yourselves a great day, and I will talk to you all